Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you have sent in. So let's get started. As always, five great questions. The first one is, are Gold IRAs, these are self-directed IRAs you open up to buy gold with, are they a good option? Number two, how to unwind an expensive portfolio in a taxable account. I can't tell you how many times I get that question, so we're going to tackle it today. Is it better to own mutual funds or ETFs in retirement? Is a rising equity glide path, that's where as you go through retirement, you actually have more and more of your money in stocks rather than bonds, a reasonable approach? And then what's the most you should withdraw from a retirement account in a single year? Is there some limit? So that's what we're going to cover today. If you'd like to send in a question, just subscribe to the free newsletter I send out every Sunday morning with the link below this video. And then just hit reply to any email you get from me. That's how I get the questions that I put on the show, and would love to hear from you. All right, so let's dive right in. Let me tell you a story about Gold IRAs. Here was the question. It was simple. What are your thoughts on Gold IRAs? I like Ruth. I mean, just right to the point. I once had a phone call with the president of a Gold IRA company, a very well-known one. If you follow that, if you've researched it, you will have heard of this company, about becoming a partner of this YouTube channel. This was several years ago. As many of you know, I'm not a huge fan of gold, but I think some allocation to it is reasonable. And he was telling me, with your community, you have a lot of folks in or near retirement. There are some folks there that might put hundreds of thousands, even millions of dollars in a Gold IRA. And he told me you could earn $50,000 from a single transaction as a commission. And I said, well, wait a minute. That sounds all nice and everything. But if you can pay me 50 grand, even if someone's putting $1 million in a Gold IRA, you must be charging them a fortune. And it turns out they are. And it's the spread between the cost, the spot price of gold and what they're charging you. Now, what that is depends on exactly the type of gold you buy in a Gold IRA. But some of the more, collectibles you could think of get very, very expensive. And I just said, yeah, look, listen, I appreciate it, but that's just not something I'm comfortable promoting. And I use my strategy for who I promote on this show is simple. If my mom called me up after listening to one of my shows and she said, Robert, because that's what she calls me, I just invested in a Gold IRA thanks to you, how would I feel? And my answer to myself was, I wouldn't feel too good. So I don't promote Gold IRAs. I really don't think they're good investments or reasonable investments. Could there be an exception? Maybe. If you are going to go down that path, forget the fact that they tell you setting up the Gold IRA is free. That's really not the point. You're going to pay for storage because you got to store the gold somewhere, and you can't store it in your house. That's not permitted, right? And they're going to charge you a markup of some kind. And if you sell it back to them because you're going to take some money out, you're going to pay selling it as well. And you need to understand what those markups are. You need to find out. Now, there are some alternatives. For example, you could just invest in a gold ETF. GLD is maybe one of the better known ones. Here's the fact sheet. I'll leave links to this below the video. I know that may be a little difficult to see. The thing that really stunned me when I look at this is that over the last 10 years, it's been up 10.43%. That's actually pretty good. That's as of June 30th. It got me wondering, how did it compare to the S&P 500? So I put them both in Portfolio Visualizer, which gives you 10 years of data. And I'm happy to report the S&P 500 did win out, but not by much. I mean, the numbers add up. S&P 500's returned 14.61%, GLD 12.55. It's a little higher even since this fact sheet was put out. This is as of June 30th. I'm recording this September 19th. But the volatility a lot lower. Its worst year is only 4%. For the S&P 500, the worst year was a negative 18%. I'm assuming that was 2022. Yes, here it is. So, gold has performed pretty well. I can't argue with the data, although, it's 10 years. If you go back and look at longer term periods, and particularly if you exclude the 70s, it's not done nearly as well as stocks. But there are certainly times when it does really well. I just personally, Ruth, to your question, I would not use a gold IRA. If I wanted to own it, I would own it in a retirement account because of taxes, and I would just buy an ETF. That would be my take. All right. Next question. How to unwind an expensive portfolio in a taxable account. It's from William. He's 79. Got a very sort of complicated portfolio, and he's wondering how to unwind it. So a few thoughts about this. Of course, taxes are the taxes. You know what your gains are. If you sell something, you can calculate the taxes. Yes, maybe you have some unrealized or some realized losses that you've carried over that you can offset against the gains. But of course, if you had that, you probably wouldn't be emailing me for my opinion on this, because you could just use those losses and that would be easy. So if I were working through this, I would do a couple of things. First, I would think to myself, all right, I'm 79. Am I going to spend all of this money in my lifetime? If there's some of these investments I'm going to leave to charity, or say my children or other loved ones when I pass that are going to get a step up in basis, I might leave them alone, right? I might leave them alone because of the tax consequences. If I know I'm going to spend it in my lifetime, or at least that's my plan, we never know how life's going to turn out, but that's my plan, I'd feel very differently about it than if I were going to just hold on to it until I passed away and then give it to, again, charity or loved ones. But the other thing I would do is I would look at this portfolio, because it includes investments that if I could pick, I wouldn't choose them, right? Maybe because they're actively managed funds that I just don't believe in, or whatever the case may be. I'm just concerned about the investments. I would do just a little historical perspective. I would go back to a tool like Portfolio Visualizer. Now, this gives you 10 years of data if you're putting in specific tickers. If you get the paid version, you can get more data. The other tool you can use, let me pull it up on the screen real quick, is Testfolio, which might give you more data for free. And I would put in this portfolio that I'm not fond of, and I would compare it to the portfolio I would choose if I could, perhaps low-cost index funds. And I would look at the performance over the last 10 years, or perhaps even longer. If I use Testfolio, again, part of it depends on the investments. Some of them may not be older than 10 years, so you may have some limits to your data. But I would compare it. What is the difference we're talking about? Now, of course, we all know the future might look different, but the past is the data that we have. And even if these are very expensive, actively managed funds, how did they perform compared to a low-cost index fund? Now, it may be that the performance was just terrible, in which case, for me, again, it's going to depend on your specific tax circumstances, so I can't answer this for you. But based on that performance, it might tell me, yeah, I need to move out of this portfolio. I might not do it all in 1 year, depends on tax circumstances. Or I could look at the individual elements in the portfolio and say, yeah, it didn't do that great compared to the kind of index fund portfolio I would choose. But there were 1 or 2 investments that were particularly bad, and I might exit those sooner, right? So I would look at the past performance to assess, do I need to get out of this portfolio? Maybe I'd be comfortable sticking with it, even though it wouldn't be my first choice if I were building a portfolio from scratch. Or again, I might identify specific investments that I think are really problematic that I want to get out of first. And then I would just come up with a plan on how I'm going to do that. Again, there's no one answer I can give you. It's going to depend on your specific circumstances and your taxes. Maybe you're in a lower tax bracket this year than you will be next. Of course, with capital gains, there are fewer tax brackets if we're talking about long-term capital gains. I would avoid short-term capital gains if at all possible, because those are taxed at ordinary income. But that's how I would think through it. When am I going to need the money? Am I going to ever spend it? How does this portfolio perform against my portfolio that I would choose if I could? Maybe it's not so bad, or maybe there are pieces of it that aren't so bad and other pieces that I want to get rid of right away. That's how I would break it down. And at the end of the day, you may still be confronted with choices that aren't easy to choose. You just gotta, it's one or the other. It's stick with a portfolio you don't like or pay the taxes. Sometimes there's just no easy answer to that question. All right, next one. Is it better to own mutual funds or ETFs in a retirement account? I actually did a video on the difference. Here it is. I'll leave a link to it below. this video. I don't know who that guy is, but he didn't have a beard. I know that. Anyway, at the end of the day, I wouldn't stress over this question. Again, we're talking about a mutual fund and ETF that are exactly the same. For example, at Vanguard, you can get the S&P 500 index fund, either in a mutual fund or an ETF. At the end of the day, we're talking about low-cost index funds like those from Vanguard. Frankly, it doesn't much matter. In the video I'll link to, I preferred mutual funds, and I think I still do. Most of our money in taxable accounts, actually, as I think about it, in retirement accounts too, are in mutual funds. I like the fact that I don't have to worry about any premiums or discounts to net asset value, which you do with ETFs. Although at the same time, particularly with funds, again, like Vanguard, ETFs that are actively, there's a lot of market for them. The spread is going to be very, very small. The premium or discount could often be just a penny a share. So not a big deal. I wouldn't stress over it. For me, I like the simplicity of mutual funds. There is a downside to it. If you want to own, say, a Vanguard mutual fund, but you're not at Vanguard, maybe you're at Fidelity or Schwab or somewhere else, you're going to pay a fee to buy it. I would say probably around $75. In my experience, there's not a fee to sell mutual fund shares, but often a fee to buy them if you're not at the company that sells them. So again, if you want to buy a Vanguard mutual fund and you're not at Vanguard, you're likely going to pay a fee. With ETFs, you're not, but you are going to pay a difference in the spread, right? The bid-ask spread. Again, it's usually quite small. So at the end of the day, I don't stress over these differences. I think either an ETF or a mutual fund is perfectly fine. That's my take. All right. Next one. Is a rising equity glide path a reasonable approach in retirement? John has a fairly long question that I'll show you here. You can always stop the video to look at it in detail if you want. Some articles I want to show you. Let me pull them up very quickly. There's two that I would read. One is from Michael Kitces. This goes all the way back to 2013, and it walks through it. He and Wade Pfau kind of popularized this approach. And so if you're not familiar with it, the idea would be you would start at some bond-heavy portfolio in retirement. Let's just, for sake of discussion, say 60% bonds, 40% stocks. And in the first 5 or 10 years, you'd spend only the bonds. And of course, the result would be, after let's say 10 years, you have a very stock-heavy portfolio because you've just left your stocks alone while you're spending down your bonds. But the idea is, if we think of that first 10 years, yeah, you've got a lot in stocks, but you're past that period of time that many view as the riskiest when it comes to the sequence of returns risk, which is just a fancy way of saying the stock market doesn't do well and or there's high inflation. You've kind of gotten through that difficult period in retirement. And so you can now handle a portfolio that's got more in stocks. That's the theory behind it. And if we go to the second article I linked to, this comes from Early Retirement Now, Big Earn. I actually saw him just last week at a conference and we chatted for a bit. And he talks about this, and I think he thinks it's an okay approach. But one thing he points out, and he goes through a lot of data, which you can check out in the article. But at the end of the day, he points out that whether this will turn out to be better for you than, say, just starting with 60-40 and staying with that kind of portfolio, there's no way to really know. Because we don't know what the next 10 years will look like. His view is, if it turned out you really didn't need to do all of this because the market was just fine, you'll be fine as well, even with a rising equity portfolio or glide path. But if markets weren't great and you really needed to take that approach, you'll be glad you did. So not too bad. I'll leave links to both of those articles. Here's my take. Number one, if you're going to follow it, you got a lot of questions you have to answer. What's your starting asset allocation? He goes through a lot of them. Big Earn does. Karsten is his name. If you look at it, different asset allocations to start with. Are you going to start with 60% bonds or 80% bonds or something else? And then how quickly are you going to change that glide path? You're going to spend down bonds. Are you going to make any other changes to your asset allocation? How long will it take you? Are you going to do this over 5 years, 10 years, 15 years? These are questions, you have to answer. But here's the other thing that I want you to think about. I recently got an email from someone in their 70s. In fact, it was on the 5 Question Friday show a couple of weeks ago. and he was kind of concerned about his asset allocation. Am I too stock heavy? What should I do? When you're 65 and you're thinking about all this, or 60, and you think 10 years ahead, you think, yeah, if I can just get through those first 10 years, those are the big sequence of returns risks, I'll be okay. And yes, I'll maybe use the rising equity glide path. And at the end of those 10 years, maybe I do have 80% in stocks or even more, but that's okay. I'll be through the sequence of returns risk. Let me tell you something. 10 years later, when you're looking at that very stock-heavy portfolio, you may not be so comfortable with it. Yeah, you may look back and say, I got through the first 10 years, but I'm 75 and I'm scared to death of a portfolio with 80 or 90% in stocks. You might be uncomfortable with the results of this rising equity glide path, not because anything bad has happened, but because it's scary to have that much in stocks in retirement. So that's just something to think about. It sounds good when you're looking at research and you see all the pretty graphs and everything works out. And yes, you're past that first 10 years of sequence of returns risk. But then you're 75, and you're grumpy one day, because we all get grumpy at times. And you're looking at your portfolio and you're thinking, I ain't comfortable with this. I don't care what the articles say or the graphs show. That could happen. Something to think about as you plan your retirement. Okay. What's next? Are we really to the fifth question? Have I done 4 questions already? I think I have. What's the most you should withdraw from retirement accounts in a single year? Here's the question. Again, I'm not going to read it all, but I'll leave it there for you. And this person, they're going to have Social Security and other things, but before then, they could take out as much as 11% in 1 year. And they're kind of concerned about that. He asked down here, would you say there's a limit to a single year withdrawal percentage or a short-term withdrawal average over 5 years? Well, for me, as I was thinking about this, I was thinking, there's got to be a limit. There's got to be a number that's just too much. But as I thought more about it, I thought, no, there probably isn't, right? Because imagine a retirement plan that you're going to spend almost all your money the first year of retirement, all of it. You say, well, that's impossible. I don't care what retirement planning software you use, what research you look at, that's not a recipe for success, except that we could then assume that in year 2, Social Security and a pension kicks in, and they cover 150% of your expenses. Well, I guess that would work, wouldn't it? Yeah, there is really no limit. Now, as a practical matter, you could say, okay, Rob, but how often is that going to happen? Yeah, I don't know, probably not very often. But now let's get sort of realistic. Could an 11% withdrawal in 1 year, as this viewer mentioned, might be part of his plan workout? Sure, it could. Just depends on the circumstances. So here's the deal. This viewer, I didn't mention their name because it's an unusual name. And whenever there's something unusual or unique about a question, I try to keep it out of the question just to keep folks, anonymous. But they use Boldin. This is a demo of Boldin. And in Boldin, you can look at your spending and distributions each year. And so this is just a demo account. And so you won't see any big spikes. Let me go here first. This is expenses. You can see they spike up a little bit here. And without going into the details of the plan, that's because of long-term care. When you use Boldin, you can change this, but out of the box, it assumes a certain amount of long-term care expenses in the 3 years before you pass away. And that's the maroon color. Let me make this a little bigger. That's the maroon color down here. So one of the members of it is a couple, that's demo that I created. They pass away here, so you see long-term care expenses, and the other person passes away here, some more long-term care. So there's a spike here, maybe not a dramatic spike. In the viewer's question, they're spiking earlier in the plan, which I can understand might give you some concerns. And you can look at retirement withdrawal percentages here in Boldin. You can see your average retirement withdrawal rate in this case is 14%. And it spikes at the end. That's where, just because of some settings that I have, where basically they spend all the money at the end. That's not unusual, though, in a plan where your withdrawal rates do spike later in retirement. That's also true, by the way, with your required minimum distributions from traditional retirement accounts. But at the end of the day, this is what I like so much about retirement planning software generally, whether you're going to use Boldin or Projection Lab, another favorite of mine, or something else, is that you can model changes in spending. So that's the thing to keep in mind. Most of the studies you read, including the 4% rule, are static in the sense that you're basically spending the same thing every year, perhaps on an after inflation adjusted basis. That's fine for an academic study or professional paper, but that's not real life. That's just not how we live life most of the time. Things happen, and yeah, you may spend more in early years because you're delaying Social Security, but once Social Security kicks in, your spending, your withdrawals, I should say, will go down. It can be very hard to think through that just on paper. You can't stuff the 4% rule into that kind of plan. It just doesn't work. And that's where retirement planning software like Boldin, I think, is very, very useful. And so, yeah, I would put my plan in Boldin. And if it's telling me I've got a percentage chance of success that I'm comfortable with, I would take comfort from that, even if I had a year with a withdrawal rate of 11%. Now, I would stress test that plan, right? I would change the inflation assumptions. I would change the rate of return assumptions on my investments. Maybe I'd throw in some surprise expenses along the way that I'm not expecting but could happen. What does that do to my chance of success? How fragile is my plan? So I would be stress testing it. But at the end of the day, if there's a 10 or 11% withdrawal in a given year, particularly if it's because I'm delaying taking Social Security, but a year or two later, Social Security kicks in and my withdrawal rates fall substantially, I personally would be comfortable with that approach. In fact, I think it's very normal for a lot of people. So that's my take. Yeah, there's theoretically not a limit. I suppose you can't spend 105% of your savings without borrowing money. I probably wouldn't be a big fan of that approach. Although theoretically, you could come up with some kind of assumptions where that might actually be reasonable. But yeah, let's just assume for now you can't. Yeah, I don't think there's a single number that you just can't go over or your retirement plan is doomed. It just depends on the specific circumstances, and you can model that with tools like Boldin. So there you go. Hope this is helpful. I'll leave links to everything below the video. If you have any questions, leave them in the comments. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.